Let's jump right into this explainer. Today, we're taking Apple's absolute record-breaking Q1 2026 data and putting it through the ultimate valuation gauntlet. We're throwing on our expert investment analyst hats and forcing the world's most famous tech giant through the incredibly rigid frameworks of legendary investing minds. So, is Apple a fundamental powerhouse that's totally worth its premium price tag? Or is it kind of flying too close to the sun? Let's find out. To figure that out, we're going to hit 6 quick stops. First, a company snapshot. Then we'll look through the Buffett lens, the Lynch lens, and the Graham lens. After that, we'll run a DCF valuation and some other models before wrapping it all up with a synthesis and final recommendation. Okay, part 1, the company snapshot. Just to ground our analysis here, Apple recently closed the quarter at $293.08 a share. Now, that is a staggering price point, and it brings the company's massive market cap to over $4.3 trillion. Basically, they're maintaining absolute dominance in the tech sector. And honestly, the recent data shows exactly why the stock is surging. We are literally looking at Apple's best quarter ever, pulling in $143.8 billion in revenue. I mean, wow. iPhone demand shot up 23% to $85.3 billion. This was totally driven by an upgrade supercycle, completely defying those broader market constraints on 3nm chips. Plus, their services segment, it hit $30 billion with an eye-watering 76.5% gross margin. All this translates to a projected 14.1% EPS growth for 2026, bringing it to $8.51, and a massive projected free cash flow jump of nearly 40% to $137.49 billion. If you're an Apple shareholder, well, this is the cash engine driving your returns. The quantitative systems absolutely love what they're seeing too. With a GF score of 95 out of 100, exceptional profitability, and a 4 out of 5 long-term fundamental ranking, the initial momentum is undeniable. But, as expert analysts, we can't just buy into the top-line hype. We need to see how this momentum actually holds up to the strictest scrutiny. So let's start with the Oracle of Omaha himself. Part 2, the Buffett lens. What's super interesting here is how vividly Apple demonstrates a classic Warren Buffett economic mode. Buffett loves a company that can generate massive returns on shareholder capital. Well, Apple's staggering 151.9% return on equity completely dwarfs the NASDAQ market average of just 20.2%. That's insane. It points directly to their massive pricing power, extreme brand loyalty, and that incredibly sticky hardware-software ecosystem that just keeps users locked in. Diving a bit deeper into Buffett's checklist, we always look for honest, capable management. Apple passes this with flying colors. They announced a $100 billion new buyback authorization and returned $25 billion to shareholders in Q1 alone. And what about debt? Extremely manageable. Their debt-to-equity ratio is sitting at just 10.8%, which is actually down from 17.5% the previous year. Earnings are super consistent, boasting a 26.9% net profit margin, putting them right in the top 17% of the NASDAQ. Finally, looking at approximate owner earnings, which we're proxying with that massive projected free cash flow of $137.49 billion, it's crystal clear that Apple is a pure cash-generating machine. So, based on quality alone, this is a strong Buffett-style buy, assuming, of course, he can find a margin of safety in the price. Moving right along to part 3, the Lynch lens. Now, the absolute crucial metric for Peter Lynch is the PEG ratio. For him, a PEG of exactly 1.0 is fair value. Anything lower is a bargain, and anything higher means you are simply overpaying for growth. So, categorized in Lynch's framework as a mega-cap stalwart, Apple currently has a price-to-earnings ratio of 35.4. Even when we factor in that really impressive expected EPS growth of 14.1%, we get a PEG ratio of 1.6. Now look, a 14% growth rate for a $4 trillion company is undeniably incredible. But by Lynch's strict standards, you're paying a serious premium for that growth today. It's definitely on the expensive side. But beyond just the PEG ratio, Lynch famously tracked insider and institutional activity, right? And here, the data gives us some really mixed signals. While overall insider selling did decrease by nearly 73%, Lynch would absolutely flag the massive move by Apple's chairman, Arthur D. Levinson. He recently unloaded 300,000 shares worth over $86 million. Yikes. Couple that with heavy institutional reduction, multiple firms actually decreased their positions by 88 to 94%, and Lynch would likely be pretty cautious here. Combining that premium PEG ratio with the institutional offloading, Lynch's framework would probably rate Apple a hold at this $293 price point. He'd want to wait for that PEG to drift a bit closer to 1.0.
All right, part 4, the Graham lens. Let's get quantitative.
Benjamin Graham is all about the cold, hard balance sheet. Running Apple through his defensive investor checklist, the company passes the adequate size test in its sleep. I mean, $4.3 trillion? Finances are incredibly strong, too. Their total debt of $8 billion is just a tiny fraction of their tangible book value of $73.7 billion. Earning stability is proven, and the dividend is growing, up 3.8% recently to 27 cents per share. Now, Apple does score a borderline 5 out of 9 on the Peterovsky F-score, missing out on some criteria related to improving asset turnover and current ratios. But still, fundamentally speaking, it easily meets Graham's defensive baseline. But as we know, Graham doesn't just stop at checklists. He calculates intrinsic value using his legendary formula, the square root of 22.5 multiplied by EPS and book value per share. So, we plug in our projected EPS of $8.51 and an estimated tangible book value per share of roughly $5.02 based on the source data, and we run the math. And guys, the result is a massive wake-up call for modern tech valuations. The Graham formula prices Apple's intrinsic value at approximately $31 per share. Does it offer a margin of safety at $293? Absolutely 100% not. But honestly, this brilliantly illustrates the limitations of applying Depression-era asset-heavy valuation formulas to modern asset-light tech ecosystems. Apple trades on its future cash flow and its brand, not its tangible factory equipment. Still, if you are a rigid, strict Graham value investor, Apple at $293 is a hard, undeniable sell.
Moving on to Part 5, DCF valuation and other models.
So to build a base case discounted cash flow model, we have to make some standardized assumptions since they aren't explicitly handed to us in the data. We're going to anchor our model on that incredible $137.49 billion in free cash flow projected for 2026. We'll forecast out 5 years, assume a fairly conservative macroeconomic terminal growth rate of 2.5%, and apply a 9% weighted average cost of capital, or WACC, which is pretty standard for the tech sector.
Let's see how this all shakes out in a sensitivity table. If you look right at the center of the matrix, using a 9% WACC and a 2.5% terminal growth rate, our calculated fair value sits at roughly $250 per share. To actually justify today's current $293 price, you'd have to lower the discount rate to 8% or aggressively assume a 3% perpetual growth rate. What this tells us is that the current stock price has basically already priced in near flawless execution and significant future growth. There's not a lot of wiggle room there.
But before we jump to conclusions, let's check one other model, comparable company analysis. If we look at Apple's PE of 35.4, it feels super high in a vacuum. But when you compare it to the NASDAQ market average PE of 36.1, Apple is actually sitting just slightly beneath the average of its peers. So against the broader tech landscape, Apple is relatively fairly valued, and maybe even a slight buy based purely on multiple comparables. And finally, Part 6, synthesis and final recommendation. Let's pull this all together. Bringing all these models side by side reveals a really divided set of conclusions. Buffett loves the quality, the moat, and the buybacks, assigning a qualitative buy. Lynch is pretty cautious on the price you're paying for that growth, rating it a hold. Graham is out entirely based on tangible assets. That's a sell. Our DCF model suggests a solid hold with a fair value around $250, while the relative comparables suggest a buy. So what's the final expert analyst verdict here? Well, at $293, Apple is a definitive hold. It's one of the absolute greatest businesses on planet Earth, but the current price offers very little margin of safety for any new capital. Yet even with the math demanding such a premium, Wall Street remains overwhelmingly bullish. Out of 41 analysts, we're looking at 25 buys, 6 outperforms, and only 2 sells, with a mean price target of $295.44. The street is heavily betting that this high-margin, $30 billion services segment, combined with a fresh iPhone hardware supercycle, will just continue to bulldoze right through any traditional valuation constraints. And that brings us to the ultimate takeaway for this explainer. Look, Apple is an undisputed fundamental powerhouse. But at $293 a share, your decision to buy or hold isn't really about Apple's quality anymore. It completely depends on which investing legend's lens you choose to look through. Are you willing to pay a premium for a Buffett-style moat? Or are you waiting patiently for a Lynch-style bargain? Ultimately, which philosophy do you trust to protect your portfolio in today's market? Think on that for a bit. Thanks so much for joining me for this explainer, and I'll catch you next time.